Hello, everyone. This is Dr. Zaidi. In this video, I'll be discussing briefly about the accounting cycle. So there are 10 steps in the accounting cycle. We start with analyzing transactions and generalize, post them, and prepare unadjusted trial balance, adjust and post accounts, then prepare adjusted trial balance, prepare financial statements with that information, close accounts, prepare post-closing trial balance, and the 10th option is optional. If we have any reversing entries, we reverse and post them. Okay, so the first step is analyzing transactions. So you analyze the transactions, whether they are assets, liabilities, or equities, whether assets are going up or down, liabilities are going up or down, equity are going up or down, and what kind of accounts are those, right? So you analyze that if you have received cash, you're going to add more cash to your business. If you have bought supplies, then you're going to add supplies to business. If you have bought equipment, then you're going to add equipment to business, right? If you have paid any liabilities, if you had any payables, then you're going to pay off those liabilities. If liabilities are increasing, you have bought supplies or equipment or any items on credit, then your accounts payable balance will go up. If you have issued any stock, then your stocks are going to go up. So this is the transaction. These are the transactions that I've listed here. So what it shows here that your balance, the older balance of cash was $3,000, supplies $2,000, and equipment. So these are your assets. You add them together. You have 35,000, 7,000, and 3,000, so 45,000 of assets. Then you have liabilities. Your accounts payable increased in this month, so by 5,000. And then you have a common stock, 40,000. That was the balance. So you have a 45,000 of equity and liabilities, and you have 45,000 of assets. So in supplies, you see that you had a balance of 2,000, but during the month you purchased, during October, you purchased more supplies, 5,000, so comes up to 7,000. So you are basically analyzing the transaction. Next step is generalize. So whatever transaction happened this month, so it seems like there are two transactions happened this one month, that you bought supplies, and you bought supplies probably on account, right? So your supplies increase by 5,000, your accounts payable increase by 5,000. Remember, supplies is an asset account. Asset has a debit balance, and when asset increases, you debit. So you're debiting 5,000 for supplies. Accounts payable is a liability account. Liabilities have a credit balance. When liabilities increase, you credit. So accounts payable is increasing here. You are crediting. Similarly, any transactions you have, you're going to generalize them. So if instead of buying the supplies on credit, if you have bought supplies on cash, then you will credit cash, which shows that cash has decreased. Okay. Move on to number 3, general ledger. Once you generalize the transaction, you have to transfer those transactions to general ledger, which is also known as a T account. So if you see that we have a T account for supplies and we have a T account for accounts payable. So you already had a balance of $2,000 on supplies, then you purchased on October 17, you purchased 5,000 more. So now you have $7,000 supplies. Accounts payable, there was no previous balance, but you have purchased you purchase supplies on account, so your accounts payable increased. Remember, it's a liability. Liability has a credit balance. So when liability increase, you credit. So if you see T account here, the left-hand side on the T account is a debit. The right-hand side is credit. Accounts payable, same thing. Left-hand side debit, right-hand side credit. So the left-hand side on supplies account shows that you're debiting this amount. The right-hand side of accounts payable account shows that you're crediting that account. Next step is to prepare unadjusted trial balance. So if you see, this is an unadjusted trial balance here. This is how it looks like. Don't get confused with the dates here. This is prepared for December. This is just to show you what it looks like. It has nothing to do with the previous transactions you have in general ledger, which shows October 17th, right? So, so just this is prepared, trial balance just prepared for December. Okay, so it shows the debit side, shows cash, accounts receivable, supplies, and equipment, and the credit side shows accounts payable and unearned revenue. Again, you start with assets and you list assets based on their liquidity. So current assets come first, cash, accounts receivable, supplies, and then long-term assets, equipment or machines or anything else that's long-term would come here. Then you start with the current liabilities. So you go with the order, accounts payable, unearned revenue, and so on and so forth. Then you go to long-term liabilities. So you go with all the accounts just like that in the order. Okay, so the accounts listed on the debit side because assets have a debit balance. So these accounts show debit balances. The liabilities, owner's equity has a credit balance. They show credit here, right? So assets and expenses are debit, and liabilities, owner's equities, and revenues are credit. Next step is to move to adjust and post to account. So we make adjustment. So if you see here in the previous one in December, we have 10,000 balance in the supplies account right here. So during December, we have used $3,000 worth of supplies. So we have expensed them out. So supplies expense debited 3,000 expense. When it increases, you debit because it has a debit balance. Supplies is an asset. When asset decreases, you credit. So here supplies are decreasing by 3,000. So if you see, then we are going to post this on general ledger. We have T accounts here, supplies, expense, and supplies. And you can have many other accounts that you are making adjustments for. So the supplies T account shows that, the supplies that you have bought during December, 1,000 worth, and there was a balance on December 1st, and then you have bought $7,000 worth, and you bought $2,000 worth again. So you had total of $10,000 worth of supplies, from which you have sold $3,000, or you used $3,000 worth of supplies, which left you a balance of $7,000, right? And then in the supplies expense account shows that that the supplies expenses are debited by 3,000. So you have now expense of $3,000, increase in your expense for $3,000. We then move on to prepare adjusted trial balance. So before we had unadjusted trial balance, now we have adjusted trial balance. We list all the items we have in unadjusted trial balance in the order they appeared. So starting with current assets, then long-term assets, and current liabilities, long-term liabilities, and so on and so forth. So if you see here, we are listing the items in the unadjusted trial balance we had, and then we have the adjustments. So accounts receivable has increased from $0 to $2,000. So we have adjusted that. We have to, the accounts receivable is asset account has increased, and then supplies have increased. Supplies have decreased by $3,000, and that can be shown from the previous entries right here and in number 5 here, that we have used $3,000 worth of supplies. Supplies has decreased by 3,000, which is shown here, and then equipment you have, but you have a depreciation on equipment for $500 for the month. So that reduces the value of the equipment by $500. So 40,000 minus 500. So net adjusted trial balance would show the equipment is worth 39,500. And then accounts payable. Here there is no activity in accounts payable and adjustment. So whatever you adjust, you put it here on this side, unadjusted trial balance is here, and then you balance it out, and this will show you the adjusted trial balance. Okay. Once you have prepared the adjusted trial balance, now you are ready to prepare financial statements because everything is up to date now. So you can prepare balance sheet, income statement, statement of retained earning, cash flow statement. All the financial statements can be prepared now. Here are some of the examples of financial statements. You have a balance sheet and partial balance sheet here because I haven't shown all the accounts here. And just to show you that the next step is to prepare financial statements. If you want to know more about financial statements, you need to watch a video about the financial statements. After we prepare financial statements, then we are going to close the accounts. The temporary accounts need to be closed. Okay, the balance sheet accounts are permanent accounts. They stay there. And the income statement accounts are temporary accounts, and all temporary accounts need to be closed, because when you prepare income statement, this is for a particular period. So for December, for a particular quarter, for a particular year, for 2021, 2022, whatever it is, right? So the income statements is for a particular period of time, whereas the balance sheet is for any point in time, how much assets you have, whether you bought those assets 10 years ago, 5 years ago, 2 years ago, 1 year ago, 1 month ago, 1 day ago. So balance sheet is based on the point in time, whereas the income statement based on the duration of time. So when there is a duration, you have to close because the new duration begins in the next period, whether it's the next month, whether it's the next quarter, whether it's the next year. So we are closing all the temporary accounts. So we have a revenue account, which is temporary account. When revenues increase, we credit. So when you are going to close, you're going to reverse that. So you are going to debit consulting revenue and going to credit income summary. Okay, same thing are the expenses account. All the expenses account are income statement account. So you're going to close them. So you're going to, instead of initially when expenses increase, you debit it. Now you're going to credit all the accounts here: depreciation expense, salaries expense, rent expense, or all kind of expense. You're going to close them, right? And you're going to debit income summary. Okay, all the accounts that you close, the temporary account, they need to be closed by income summary. So they are closed now here, $100,000 worth of revenue closed. Now you can start from scratch during the next period, $30,000 worth of expenses closed. You can start again for the next period. The next step is prepare the post-closing trial balance. So once you close all the account, then you can start listing all the accounts you have here, starting from cash. All the current assets are listed, then long-term asset and current liabilities, and so on and so forth. You list them, and obviously the trial balance needs to balance once you enter all the accounts here in the post-closing trial balance. And this is how post-closing trial balance looks like, very similar to pre-closing trial balance. Okay, except that it has adjustments and closing. All right, the next is an optional item. You reverse and you post. So in some periods you may not have reversing entries, so you don't have to worry about it. In others you do. So if you have a reversing entry, you do that. So for example, salaries expense and salaries payable is reversed. Maybe you entered it by mistake and you were not many payables for you, or for whatever reason. So you are going to reverse it. Salaries expense, you're going to credit, means expenses decreasing, and salaries payable, 500 debit means you no longer have to pay this amount. So this shows the how you reverse and post. Again, you don't have to learn the process how you do it. It just wanted to show you that this is an optional item of the 10th item in the accounting cycle. And that completes this topic. Thank you for watching my video, and please subscribe my channel for live updates.